Like the big change here in the journey was that from the time that you start when you launch a business, there's an era of you learning from your own mistakes, right? You either learn from your own mistakes or you hire someone to teach you so you don't make those mistakes that are costly. So at the beginning, in 2017, 18, for my first investments there, I learned from my own mistakes. But the difference between that and today is that we actually pay to be in the rooms with high level people that can really help us take us to the next level.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us George Salas. George is the CEO and founder of Empress Capital, a real estate investment firm where he focuses on short-term real estate. He is also an inspirational speaker, fund manager, and short-term rental investing coach. George, welcome to the show.
Tim, brothers, thank you for having me. It's an honor. It's a pleasure. I know we've been connecting here lately, and I am looking forward to delivering some awesome nuggets to your audience today. Thanks for having me.
Yeah, and there's no doubt in my mind that you're going to do that. I'm also not worried about the energy level because you usually bring enough for everybody. So that's going to be infectious on today's episode. I gave everyone a brief overview of your background, but as on this show, we really try to dig into the details of how you got to where you are today. So please give us a little background on your journey and what you're up to.
Yeah, absolutely, brothers. I'm going to take us back all the way until I was 6. So that's okay. My journey really started when I was 6. I was born in Peru in a very small town, right? And at 6 years old, we were living in the capital, Lima. And one day, my mom just walked into our bedroom, my brother and I, and essentially said, "George, we've got to go visit your grandmother." So given I didn't know that my parents were getting a divorce, right? So they got divorced at 6, and mom, myself, and brother moved to a very small town, back to the small town, right from the capital, and essentially moved into an adobe house. So I grew up from 6 till 15 in an adobe house where half of the house had collapsed, right? This is a place called Tarapoto in Peru, right? Very small city. And it's what they call the jungle over there, right? It's essentially the valley, the Amazon side. And they lifted one side of the house because the roof had opened up and we didn't have the money to fix it up. So the whole entire living area collapsed. So that was me growing up, right? And essentially, what we would do there would be play soccer on the streets and really just grow up very poor. And mom was a single mom and essentially was working very hard for us to be able to really live and create the life that she wanted for us. And she ended up actually remarrying, and essentially we were able to move over here to the US and right before 2000. And essentially we moved here, didn't know English or anything. Fast forward a few years after that, I had gone into hospitality. Right now, us being privileged here in the US, a lot of people talk about the American dream, right? A lot of people don't have the opportunity to really create the life that they want for their families and for themselves. So for me, it was a privilege being here. Fast forward 7 years, I had gone and grew up a little into the hospitality. I entered the hospitality business. So I was working at restaurants, working in bars. And as I grew up, I ended up entering the true hospitality. So I created a marketing business and a marketing company that would market events and it would market venues. So we would do this whole thing for 10 years. We were creating events and venues. So we would create the events, we would produce the events, and we would host the events, right? And about 2015, right? I'm 7.5 years into this business. And I actually ended up becoming an investor. So my first investment was as a limited partner, as an LP. Right. So I had invested into a new nightclub / venue, right? This is from 2015 to 2017. Okay. And we built it out. We ended up having a 1.3 million venue after that. And I had partnered with this gentleman who was the only GP in the deal. So take opening of the venue. We opened up in $1.3 million in debt. Now the venue's doing well. Fast forward 2 years after that, guess what happened to him? The entire venue had got shut down. Okay. And the reason for getting shut down was that the partner did not have the ability to renegotiate the lease from the past rent on that triple net lease. So the investors, us, the entire partnership, we lost everything that we had put into it for 2 years. So now I'm not blaming this GP for doing that. A lot of it was also us not doing the proper due diligence. So biggest lesson here is do your due diligence when you are partnering with anyone, when you're seeking out joint ventures, any kind of partnerships, when you're doing business with someone. That was my biggest lesson. My second lesson was diversify. Don't put all your eggs in one basket. I was reading recently a book by Tony Robbins called Money Master the Game. And he goes to the chapter 5. I'm like, wow, diversify your investments in, and he goes with this one line, right? Diversify or die. So I'll never forget that one. So since then, we've been able to really wake up out of that realm of the industry. I realized that after that one event, I had nothing. I was stuck into one investment and then I had lost everything. And that's what got me to real estate. This is 2017, Tim, right? So 2017 comes around, the venue gets shut down, and then I lose everything I have. Now I go from being a business owner, having my own group, into opening up, saving, taking a lot of the savings that I had and investing it into this business, to losing everything. So the next step for me was like, well, what am I going to do? Am I going to stay where I'm at, or am I going to get up and work even harder? Right? Am I going to get up and not stay where I'm at and go to the next level? So I started studying. I started taking courses and going to conferences and reading books and attending networking events so that I could, really learn what real estate was, right? 4 months later, I got my first real estate deal launched. And fast forward a year after that, I had done over 25 deals. This is single family deals starting from short-term rentals to fix and flips to wholesale deals. But by the end of that year, being my first year of real estate, I was just on the grind. When you're getting started, sometimes you just have to take action, right? And just move forward and figure out if this doesn't work, this will work. So for me, it was a journey of figuring out like what in real estate's really going to work. So I was testing out the fix and flip model, which to me was like, okay, we've got to put quite a bit of capital. It fluctuates. You're speculating when you sell. So it wasn't for me at the time. I needed cash flow. So then I went into wholesaling. You don't have to buy the property. You essentially are signing a contract. And then that was cool. And then I went into short-term rentals. So for me, was cash flow was the thing that I needed at the time, right? So rentals create cash flow. Yeah, right. So we would actually negotiate these leases with multifamily business owners like yourself, right? We would negotiate leasing 5-10 units from them. And what we would do with this, the model is called rental arbitrage in the short-term rental industry, right? When you rent and then you sublease. So we would do, that's how we got started, right? So we would do that. And by the end of 2018, which is my first year, right? We had 10 short-term rentals. By the end of 2019, we had about 36 or 37. Okay. So our growth was exponential in that year. Okay. And by the time COVID hit, I had almost 38 or 39. And then 3 or 4 of those, Tim, were houses. And the rest, 35 of them, were apartments. And we were renting condos, 1-2 bedrooms. And when COVID hit, for me, it was a wake-up call. My houses continued to perform. Unlike multifamily operator or long-term tenants were still paying their rent. But while that was happening, for people that were traveling, my 35 apartments were within a 2-mile radius of downtown in Houston, Texas. So we had a sort of a ghost town 3 to 4 weeks. And then this is where I realized that I was essentially putting one of the same mistakes that I made in the first time that I did an investment. I was focusing too much in one area and I was not diversifying enough, right? So from there, we ended up actually realizing that what we needed to continue to thrive in this business, even during COVID, was to go for the big dogs, is what I call, right? And what we realized is that the houses for us were cash flowing, right? While the apartments were, a lot of them were breaking even and some of them were cash flowing, but we had these 2 months during COVID, April and March of COVID, everything was shut down. So we put lots of effort in to be able to, continue the transition there. And Fast forward a couple of years from there, we have changed our portfolio. It converted our portfolio from lots of smaller units more into mid luxury short term rentals. Our focus today is taking single family, mid size, medium price single family residential short term rentals with built in amenities and converting them into luxury short term rentals that are well amenitized, that create higher revenues, right? And a little bit more info on that. Fast forward to today, we've been able to really spend a lot of time really dissecting the short-term vacation rental model, learning from our own mistakes, and being able to build out not just a system, but also expanding our portfolio into doing joint ventures, into creating different types of partnerships. And then now we've launched a private equity fund, right? So our private equity fund is solely focused on short-term vacation rentals. And literally, we just went live about a month ago. And we're going to be investing in 3 to 5 different markets. We've got a pretty cool strategy when it comes to recession resistant, Tim. So we've created the recession resistance strategy. We can dive a little bit deeper into as we go into in the interviews here. But yeah, now I get to hang out with great people like yourself. I'm surrounded. Obviously, we've met in the Race Masters Mastermind. But like the big change here in the journey was that from the time that you start when you launch a business, there's an era of you learning from your own mistakes, right? You either learn from your own mistakes or you hire someone to teach you so you don't make those mistakes that are costly. So at the beginning, in 2017, 18, for my first investments there, I learned from my own mistakes. But the difference between that and today is that we actually pay to be in the rooms with high level people that can really help us take us to the next level. And now I get to surround with people like yourself, and I get to build out these larger businesses, larger joint ventures, and now we've got an amazing business model here, man. So I hope that was a little bit of info on the journey for you, brother, for your people out there.
Yeah, no, there's so much to cover. And I think just from the beginning, I think the theme that resonates for me is resilience, right? When you grow up in a rougher environment, you got to make do with what you got. There is no just giving up, right? Like you just get on and do what you got to do. And I think that builds a certain amount of resilience in folks so that they can face challenges in the future. And that's something like as a parent that I'm always struggling to try to figure out what to do with my own daughters, right? Because I wouldn't say they're spoiled, and I try to do everything I can to make sure they're not spoiled. But I also want to challenge them so that they do build resiliency, make them do things that challenge themselves, whether that's sports or business or anything else, something where they have to overcome in order to move forward. But it sounds like you got that naturally growing up and not dissimilar from my wife, who I wouldn't say she's super resilient in the same way. It's just that a lot of things just don't bother her. Like she is completely unfazed. And I think that's in part too to some of the things that she faced growing up because she was born in a Thai refugee camp, lived there until she was
Really?
6, and then got sponsored. Her and her family got sponsored and came to the US when she was about 6 or 7 years old. So I think all that stuff just makes us better people. It makes us better able to handle challenges as they come up. And anyone who's in commercial real estate right now is facing some challenges, most likely. And I've seen some operators who are not handling it right. They're almost
Mhm.
hiding from it when this is a time when you need to face it head on. And I think I got my resiliency primarily from the military, right? There is no I quit. It's you better figure it out and make it happen. And that's what a
Mhm.
lot of folks are having to do right now. And then you talked about your time going into hospitality, and I'm sure that taught you all kinds of things just from interpersonal skills, right? Dealing with people, because that's just something you have to do in the hospitality industry, which is always helpful, right? Knowing how to deal with people. Into your actual real estate experience, you talked about your first deal essentially as a limited partner, as an investor, being
Mhm.
this club, this venue. I think that's pretty unusual because we don't hear about those kind of deals as often, right? Sometimes we hear about whether it's short term rentals or apartment buildings or storage units. We hear about being an LP on those kind of deals a lot, at least in our circles, but we don't often hear about the more unique real estate or businesses, is really what they are,
Mhm.
like that. Tell me how you like came upon that and how it was pitched to you when you first learned about it. And understanding that you didn't do enough due diligence. And I think a lot of us are guilty of that because we get excited by the opportunity. But what was attractive about that deal and made you willing to put what I'm guessing was a significant amount of money for you at the time into that deal?
Yes, it was a lot of money, over $300,000.
Whoa.
So, yeah. First off, in this industry, right, when you're there, it's maybe 2,000 people in the industry. Everybody knows each other. It's like a small community, right? And then now you have the clients that go into this community, right? Meaning the fickle 500 people that frequent these venues, and they all just travel around the hottest venues in town. And there are maybe lawyers, maybe dentists, maybe business owners, maybe, whatever, investors, right? Who love to frequent these places. So the owners themselves know each other. It's very small, right? The deal came about from a business owner that I actually was marketing his venue. To
Okay.
me, he's, hey, I'm going to close this venue down, which should have been a red flag for me, right? And then I'm going to open up this other deal, and I need your help, right? While we were making him thousands of dollars every Tuesday and every Saturday, then he saw that we were making money. He saw that we had the funds, and essentially this GP became our best friend, my best friend. So he became my best friend, was really not really my best friend, but he was faking it. So from there, I was able to, I didn't have any skills. Like I didn't have any investing skills. And this is the biggest and probably the biggest and most, I would say, the biggest and also the best mistake I made, because it didn't teach me to lose or invest only. It also taught me that I need to learn about this product before I go and dive super deep into it and I put all my eggs in one basket, right? It came about to me, and it was a upfront deal. And then I looked at it and I looked at it. I didn't know how to do my due diligence, right? So without the necessary skills, I went and pushed the trigger. But then it became a prolonged deal, right? It was late on launching. It was around, it was a lease. So didn't even own the land. So at the end of the day, I ended up pulling the trigger, and then we didn't open up until a year and a half, 2 years later. And it was a ground up, ground lease with the ground up construction. And we opened up in such a debt. So it was the worst and the best deal. Worst because obviously I lost everything I had and had saved, but best because it sparked something. So after being in rock bottom, after the deal got shut down, I realized that I needed to be better and I couldn't stay where I'm at. So when you're out there and then you've gone through a tough time and whatever it is, for the people listening out there, like this happens to everybody, guys, right? We all go through that. So we just need to get our butts up and go work harder. So I took it and it became a lesson, right? Tony Robbins says that bad times create strong people and good times create weak people. To me, I've gone through bad times. So that equals to what you said. You mentioned resilience, right? So resilience is one of the keys to succeeding in business because you're going to have fall downs no matter what. You just have to learn to get up harder and start jogging first, right? And then set up your mind or reset your mind and then go get that next goal, right? And no matter what, if you lose 9 times, but you win one, you've won, right? You've made it, right? Meaning if you go and try this business model, if you go and try that, like a lot of people fail on their first try, right? As a business owner, I'm sure you have, I have failed when I tried, right? So maybe my first deal, 1 or 2 didn't work out, but the fourth, the fifth, those worked out. And now you've got the resilience and the grit to be able to deal with them. And a lot of people, like you said, out right now out there, they don't know what to do because what's happening in this market, right? It's something we don't see very often, right? Maybe every 10 years or so. So that was a little bit about the journey and how we dealt with that deal, Tim.
Yeah, and I think that's important. And it's an important lesson for passive investors or potential passive investors because, in terms of success, like you said, in business, the first thing is taking action, right? If you don't do anything, then you can't get anywhere. But a lot of times when you take that first action, it's going to hurt, right? You may fall down. Like this could have been devastating. And a lot of people would have just said, hey, this obviously isn't for me. I'm not going to do anything related to real estate or passive investing or anything like that again. And then just go back to the safety and security of the stock market or whatever it is. And when I bought my first duplex, and within a couple of months, I had a tenant move out, had to fire my property manager, like all those things piling up. I could have been like, you know what, this real estate thing, it's obviously not as good as it was made out to be. And it could have stopped right there. But like you said, you learn a lot of valuable lessons and you're like, okay, next time I'll do this. Next time I'll vet the property manager better. Next time, you know what I mean? And so you learn a lot of valuable lessons that will ultimately make you successful on deal number 2, deal number 3, deal number 4, whatever it is going down the road. So I think that's great that one, you didn't just stop where you were, because again, that would have been a devastating loss for so many people. But you decided to say, all right, let's get back up and let's figure it out. Because obviously, like you said, you didn't educate yourself enough on that investment. And so you paid the price, both figuratively and literally. But that lesson, I'm sure, has stuck with you ever since. And sometimes those are the most powerful lessons, are those really expensive ones.
I used to think, Tim, that this happened to me, and I used to be angry at this person for years, right? Then I realized that everything happens for you, right? Not to you. So that's where I said the best. And I stuttered for a minute because I was like the worst and the best, right? Because if that didn't happen, we wouldn't be where we are today. And for me, I like to look at what I've gained instead of where I'm not or what I've lost, right? There's a book called The Gap in the Gain,
Mhm.
right? By Benjamin Hardy. I love that book because before that book, I used to look at, well, I haven't made it yet. I'm not making $1 million net every year yet. Or I don't have 100 properties yet. Today, I look at it a year from today. I didn't have X. 2 years from today, I didn't know XYZ, right? So I love that fact, right? So a lot of us don't do that. We live in this world where we're just looking at where we haven't gone yet or where we've lost and we live angry. That was me for several years.
It's all about that shift in perspective. You're absolutely right. And then another thing that you keyed in on, sorry, was diversification. And I think I was talking to someone about this today, that, hey, they're like, yeah, I want to invest in real estate at some point so that I can diversify. And I think that's like the issue, right? Like most people are not diversified at all. They think that I have several different stocks, so therefore I am diversified. And as far as I'm concerned, that's a whole lot of different of the same thing, right? If you have a bunch of different colored eggs, you still got a basket full of eggs, even if some are brown, some are red, and some are white, and they're all in one basket at that point. So I think pieces of the education that I try to put out there are just, hey, like you have the illusion of diversification right now, but you don't have true diversification until you go into other assets. And then even myself, I needed to remember, because some people, you go all in on real estate, like that's it, all, real estate or nothing. And those people are wrong too, because real estate is still a single asset class, and you have to diversify even within real estate, right? Commercial multifamily, for example, right? There's so many different things, even within commercial multifamily, that you could do. You could diversify by asset class, whether it's an A class apartment, B class apartment, C class apartment. You can diversify by sponsor. And while I would love everyone to invest with me and only me, I accept the fact that for their own benefit, they should be diversifying the sponsors that they're working with. That way, again, you have that diversification by the people that are being stewards of your money. So there's so many opportunities to diversify even within real estate. But again, just at least diversify, because so many people are not diversified right now. And that is key to safety from a financial standpoint. Going into your background, you did what I hear a lot of people that come on this show do, is they get into real estate and they try different aspects of it, whether it's buying that single family home and renting it out, or going into fix and flip, and then quickly realizing that it's one, a full-time job, But two, there's the other challenges involved. You said a lot of upfront capital, and it's just very intensive in terms of what you have to do to make those deals happen and to be successful. And then you talked about wholesaling, which is like the other end of the spectrum in terms of you don't need a whole lot of capital to get involved, but you still got to do a lot of legwork and really make those deals happen. So that could be challenging too. And then finally, you settled on short-term rental because you felt like that was the good balance. I think what's interesting though is that you've since shifted. Now, you specifically said that when you started doing short-term rentals associated with like apartment buildings, that you were making deals with those owners. So my assumption is they always knew and it was always approved that those subleases were in place. Is that right?
Yeah, it wasn't a full master lease, but yes, it was leasing 5 to 10 units from each owner. Yeah, and there was always disclosures in there. We disclosed that we were doing it. They were completely okay with it, right? So my biggest mistake was having them all with so close to each other.
Yeah, and I just say that as a point of caution for some people because one of the challenges associated with short-term rentals is the lack of clear regulations associated with it, right? A lot of different cities and counties even are trying to figure out how to regulate short-term rentals, and some are doing a better job than others, and some are being onerous in terms of the regulations. And sometimes it's just really confusing because it can vary from literally county to county, or even, I've heard city to city in terms of what the regulations are. How do you deal with that? Is it just a matter of, going to the city or the county, figuring out exactly what the rules and regulations are? Are there resources for that before you guys go into a market?
Great question, Tim. Absolutely. So, what we look at things based on when we invest, when it comes to regulations, we essentially first look at the city allows. You got to look at the city level and you got to look at the zoning that the city allows. Then there's also smaller regulations within the HOAs. We don't like to go into HOA zone neighborhoods. The majority of the properties that we purchase are either unrestricted or they're HOAs that allow that. Today, we don't purchase or we don't go into multifamily like we used to, but it's all single family neighborhoods. And here, at least in Texas, there are unrestricted neighborhoods. So when it comes to dealing with that, now we obviously are going to go into different markets once we get our acquisition teams going, right? So now, as far as that, we're going to go through the same process, right? Now, every city, whether it's a small, medium, or large city, right, metropolitan city, has a set of regulations in either in place or they're developing them or they don't have anything, right? So what we like to do is also diversify between cities that have strong regulations, which are already set in place. That way, there's less supply because it's regulated. And in cities that don't have any, which there are a lot, iffier ones, right? The ones that are riskier are the ones that don't have any regulations, but they have them in place and they've created some because these are the newer markets. Let me give you an example. Let's say the island of Galveston, Texas, right? Galveston, Texas already has permitting in place. And then not many of the neighborhoods in Galveston Island have HOAs. So you could go in there, get a permit, and it's already regulated, right? It's not heavily regulated, right? But you could go in there and get a permit and you're completely fine. Now let's fast forward to Dallas, Texas, who just essentially the residential zoning just banned all the short-term rentals in Dallas. In there, you can only go to commercially zoned areas. So we go into a market like Dallas, we will either be outside of Dallas, which is not very far. I mean, you drive 30 minutes outside of Dallas and you have other cities around it, or inside the loop of commercially zoned areas. Now, in those areas, you couldn't find too many single family, but you could find them right outside Dallas. So just a quick example to go through how we're fighting regulations. Yeah, I don't want to fight any cities or get into lawsuits. I've already been sued by an HOA back in 2019, so that's over for us. So we just take different measures to not make those mistakes again.
Yeah, and that makes a whole lot of sense, especially with the HOA aspect. Like, I don't even like buying a house with an HOA, let alone for business purposes, because they can be very litigious for the smallest things. So you don't even want mess with that. The other aspect that I always think about when it comes to short-term rentals is saturation, right? We see some of these markets that are like tourist hotspots that just become saturated over time, right? This doesn't happen overnight, but over time, people rushed in to buy short-term rentals because it made sense, right? These are places that people wanted to go, but people kept buying short-term rentals, and so it has this knock-on effect on everyone else to where there's this oversupply. Is that something that you've seen or you've run into over the course of your business over several years?
100%. Okay. So let me break down exactly what types of, like, when it comes to categories, right? You have four main types, right? You have budget, you have economy, mid luxury, and then you have luxury, right? And then you could categorize that in your budgets are going to be on the bottom 25% revenue, just to give an example. Your economies are going to be on the bottom 25. Your mid luxury is going to be on the top 20, the bottom 75, right there. So between 50 and 75. And then you have your top 25%. Most people, when they start, they go and create a budget property, right? Whether it's because they purchased it and they just threw furniture out there. That's what I did. So we create, whether you're doing it in any, no matter if you're doing it on the water, right? If you don't go in, you don't create an environment of luxury, then you're going to compete as a commodity. What that means is that 80-90% of the properties out there are commodity. We specialize in not being a commodity or being a mid-sized property, but creating a luxury environment by providing the amenities that people want in that market. We know how to do the back end research. We know what people love, and it's different in every single market, right? So we're not going to go to Miami and then try to find a property with like pool, hot tubs, and beers because the real estate's going to be expensive. Over there, we focus on something else, maybe waterfront. If we're in a mountain town, it's different. So it's different in every area. So we essentially don't suffer that. At the beginning, we did. And for the last few years, we've changed our model since COVID, going from budget properties to luxury. Right now, we're not buying luxury real estate. There's a difference there, Tim. When you buy a luxury real estate, it's $300 to $500 a square foot. We're buying medium price real estate and converting it into a luxury rental, short-term rental, right? Which now creates our own unique niche, right? So we well amenitize the properties. We make sure that we go into markets that have the demand for bigger properties, right? We create our own niches, which puts us in a completely separate category. Now, going back to the saturation part, this market is definitely saturated, but short-term rental markets are just like real estate markets. They are local, right?
Right.
So as operators, we go into these markets and analyze them and figure out like which markets have more economic or affordable pricing when it comes to real estate. And if these markets already have regulations in place, these are big reasons for us to look even farther, right? Because we can find less supply and more demand for the larger monetized homes, right? So then we go in there and do our thing, and now we've created our own niche, right? So that's how we approach when it comes to market selection or property selection. It's obviously one of the handful of very solid strategies that we do in our business model.
Yeah, that makes a lot of sense. You're differentiating yourself and you're creating a higher barrier of entry for competition, right? Because if they want to play in that same category, then it's going to cost them and they're going to have to do the work. Whereas at the budget level, very low barrier of entry. Anyone can go buy a fixer upper and throw some furniture they found on Craigslist in there and call it a day. That makes a lot of sense. So we are running close to time, but I do want to ask you about the fund and, specifically for educating those passive investors who are considering getting into real estate. What are the unique advantages to investing in a fund specifically for short-term rentals, and how are short-term rentals, are funds different in either a better way or pros and cons associated?
I love the question, brother. Thank you for asking that. So specifically, when it comes to investing in a fund in short-term rentals, our projections on cash returns are going to be higher than your goal. That's one, right? So now we invest in highly appreciating markets. another one, right? And that's most short-term rental funds out there. Now, what's unique about ours is number one, that we're acquiring all of majority of our properties within our portfolio in a creative finance acquisition strategy, right? So we buy a lot of them subject to the mortgage. We take over payments at very low interest rates, which dissipates a lot of the risk, right? Because we're at a 9.89% interest rate environment today, but we're buying properties at 3-4%. And we don't have to set up the financing because it's already in place. We're just taking over the financing. We have bought dozens of properties that way. So that's one. The other one is that we go for the niche, right? We go for that niche, high end look and delivery. So whether we're buying 3-4 bedroom sub two, we still already know that we have to have certain amenities within that property, and then we enhance them. So we create a niche. We create what Alex Hormozy says, like an irresistible house, right? Something that somebody can't say no because they'll feel stupid not to rent it, not to buy it, right? So a great package. All of our houses, we take that same $100 million offer concept from Alex Hormozy from his book, right? I'm quoting his book, by the way, right? And then we apply it to our market. We create a property that is so beautiful in all aspects, right? And we deliver the best. And number three, we have a recession resistant strategy where we've gone and done historical research, and we've taken a list of the top 100 markets from 2007 to 12, right, that performed at a slow growth, relative growth change, right? And our strategy behind that is called a relative change strategy, right? So essentially, we take the sector of real estate, slow growth markets instead of exponential. We take the same thing on the hospitality side, right? We take hospitality data, we merge them together, and we take the ones that cross over. Meaning, we're going safe on the real estate side, we're going safe and high performing on the short-term rental side. That's our buy box in the middle. And then we compare those data to today's metrics of revenue and how they are growing year over year with demand, how the supply is growing, how the revenue is growing in those markets. And this is to the nitty gritty. I'm talking about to the penny on how we've applied our research. That's the third point that makes us different, right? So we've done hundreds and hundreds of hours of in-depth research to be able to come up with that strategy altogether.
Yep, you're looking at that more macro regional strategy and looking into all the fundamentals, the metrics there. That makes a lot of sense. And then I imagine that it's somewhat CapEx intensive if you're buying like a B property in an A neighborhood and you're going to make it luxury. You got to put some money into creating those amenities where they didn't exist before you're subject to. Is that correct?
It could get CapEx intensive, yes, where the property or maybe has a pool and we have to add lots of amenities around the pool. Yes. But the advantage for us is that we're putting down payments of 20, 30, and 40,000 for these $400,000-$500,000 houses. So the CapEx, instead of putting it as a down payment, we're adding it, and it's still coming in at a great 12 to 15% under repair value, right? Under LTV. So we're coming in and we're buying these properties with I would say good equity, right? We're also diversifying our strategy when it comes to investing, right? We're doing value add, we're doing sub twos with some CapEx. Not all of them need that high. Not all of them need 100,000. Some don't need any. And then we're going to be doing some retail purchases, maybe about 10% of our portfolio here.
Yeah. And I think obviously in this current interest rate environment, getting something with creative financing like that is a huge advantage. No different, on the commercial multifamily side, if you're able to do a loan acquisition, right? Same kind of deal, because you're getting that loan rate as it existed when they got it. You're just doing it with the owner being the lender, essentially. All right. This has been some awesome insight. I love digging into the details because I don't play in the short-term rental space as much. So it's always awesome to have someone who knows their stuff on here to educate me. But we do need to move on to the turbo round. So I'm going to ask you
Perfect.
3 questions that I ask every guest that I have on the show. And I just ask for a quick, honest answer. You ready?
I'm ready. Let's go.
All right, let's do it. What is one red flag that every investor should look out for?
Okay, that one, I think a generalist, right? Someone that does not specialize, right? An operator that does not specialize and is a generalist, right? They're not specialized in one asset class, but they do everything in real estate because that means they're not masters of their craft. So you're commercial, right? I'm short-term rental, but there's some investors out there. Hey, I do it all, and I was a generalist. So that's one thing.
No, that's a good one. And I don't think anyone's actually mentioned that one on here. So kudos to you. All right, the next one. What is a myth about this business that you would like to set straight?
Let me think of that one. I'll say the stock market is the safest and most consistent way to invest for long-term.
Agreed.
Right?
And you're going to hear it over and over again if you're watching CNBC or Bloomberg or any of those, because I don't know, I feel like they're just paid by special interests who are in the stock market. So it makes sense, right? But I agree with you. I think that's a myth. And then it goes back to rule number 1, which is diversify. There's nothing wrong with the stock market inherently, but sometimes people use some voodoo statistics to talk about the returns over time. And it's, yeah, but how would I have been invested for 100 years? You're talking about an average over 100-year timeline. That doesn't exactly match up for when I want to retire. It doesn't help me a lot. All right, final question. What does success look like to you?
Doing whatever I want, whenever I want, with whomever I want. That's what success looks like.
Love it. That freedom piece, right? Time freedom, financial freedom, all of it. All right. Hey, George, this has been awesome. I know I had a lot of fun. I hope you did too. And I hope the listeners did. Please tell them how they can get a hold of you and if there's anything else that you'd like to share.
Yeah, absolutely. You guys can get a hold of me at George Salas 360. It's my social media website, and I love to connect. So I've got all my socials in there, and yeah, that's it. And then as far as something else, brother, it's been a pleasure here being with you and then learning about what you do as well. So thank you for having me, and I hope everybody out there got lots of value today.
I'm sure they did. And we'll have all that contact information in the show notes. George, thanks again for coming on. And I look forward to seeing you do big things on your journey to short-term rental millions.
Thank you, brother.